Bear Stearns, once a leading global investment bank and securities trading firm, was founded in 1923 and rapidly grew over the decades to become a major player on Wall Street. Specialized in mortgage-backed securities and asset management, the firm had weathered multiple financial storms and earned a reputation for its resilience. However, the financial crisis of 2007 and 2008 led to its dramatic downfall. The excessive exposure to subprime mortgages and the subsequent collapse of the housing market triggered immense liquidity issues, leaving Bear Stearns trapped in a financial quagmire that it could not escape. By March 2008, Bear Stearns faced a severe crisis as it struggled to meet its daily operating expenses and cover its obligations. This situation prompted the firm to seek emergency funding from the Federal Reserve to avert bankruptcy. In a desperate attempt to stabilize liquidity, Bear Stearns approached JP Chase, which recognized the potential for acquiring the struggling firm at a deeply discounted price. Ultimately, an agreement was reached, and Bear Stearns was sold for just $2 a share, a stark contrast to its stock price of nearly $170 just a year prior. This transaction shocked investors and signified the crippling impact of the financial crisis. The decision for JP Chase to acquire Bear Stearns was not just a lifeline for the embattled firm, it was also a critical move to stabilize the broader financial system. The Federal Reserve facilitated the deal, providing JP Morgan with nearly $30 billion in financing to absorb Bear Stearns' most toxic assets. This intervention aimed to prevent further loss of confidence that could lead to a cascading collapse of other financial institutions. However, opinions were divided on whether the Fed's actions set a precedent for future interventions in private sector bailouts, raising questions about the moral hazard associated with such government involvement. As analysts dissected the aftermath of the Bear Stearns episode, various lessons emerged regarding risk management and regulatory oversight in the financial industry. The credit default swaps market, which had hidden the level of risk associated with mortgage-backed securities, came under scrutiny. Many industry experts called for tighter regulations and more transparency in financial products to prevent similar crises in the future. This event underscored the interconnectedness of major banks, where the failure of one could have catastrophic effects on the wider financial system, prompting discussions about systemic risk and the importance of monitoring institutions deemed too big to fail. The fallout from Bear Stearns had far-reaching implications beyond the firm itself. It served as a precursor to the larger collapse of Lehman Brothers later in 2008, which ultimately pushed the global economy into a recession. Investors and regulators were awakened to the impending dangers posed by excessive leverage and inadequate risk assessment practices. During this turbulent period, confidence in the banking system plummeted, prompting runs on various financial institutions as depositors and investors sought to safeguard their assets. In the years that followed, the financial industry underwent significant transformations. Stricter regulatory frameworks were introduced, such as the Dodd-Frank Wall Street Reform and Consumer Protection Act, aimed at increasing oversight and reducing systemic risk in the sector. This legislation imposed higher capital requirements on banks, mandated stress testing, and sought to limit the complexity of financial instruments. While some experts argued that these measures were necessary, others raised concerns about how such regulations could stifle innovation and limit credit availability. The legacy of Bear Stearns also serves as a cautionary tale for investors and financial institutions alike. The dramatic downfall of such a significant player in the financial markets highlighted the importance of due diligence and the perils of complacency in risk management practices. As markets have evolved, the need for continuous assessment of investment strategies and an understanding of underlying risks remains more pertinent than ever. Investors today must approach their portfolios with a level of skepticism and thorough analysis to avoid falling into similar pitfalls overshadowed by the lure of high returns. Reflecting on the Bear Stearns saga brings to light the complex interplay between market dynamics, regulatory environments, and the behaviors of financial institutions. The integration of lessons learned from this chapter in financial history serves as a blueprint for navigating future economic challenges. While the monetary system has proven resilient and adapted to changes over the years, the fundamental principles of managing risk and fostering transparency remain key to ensuring stability in the global financial landscape. As we move forward, remembering the events surrounding Bear Stearns can help guide future generations in their endeavors within the financial industry.